It wasn't that long ago that NIO seemed poised to post a breakout fourth quarter. The Chinese EV maker had delivery momentum driven by the new brand Onvo, which began boosting deliveries at the end of 2024. It also had a good third quarter when it improved vehicle margins amid a challenging environment, and it launched yet another brand, Firefly, that was positioned to drive the top line even higher throughout 2025. But then the Q4 earnings report disappointed both investors and analysts with poor financial results. So what exactly happened? One of the biggest reasons to buy into NIO stock in 2024 was that the previously mentioned Onvo and Firefly brands were set to drive deliveries higher and generate more sales growth for NIO. Although some aspects worked as planned, the sales volume was insufficient to achieve the top-line growth needed to meet the Q4 targets established by NIO management and that were anticipated by both analysts and investors. In Q4, vehicle deliveries reached 72,689, and that figure breaks down to 52,760 vehicles from the premium NIO brand and the remaining 19,929 vehicles from the family-orientated brand Onvo. The sales result was a strong 45% gain over the prior year's Q4 data and a big 17.5% increase from Q3 2024. However, that vehicle delivery growth was not enough to drive the top-line revenue quite as investors had hoped. Total revenue jumped 15.2% from the prior year and increased 5.5% from Q3 2024. These numbers suggest that NIO is building its sales volume in its primary market of China, but the Chinese EV market remains hyper-competitive, with BYD and Tesla dominating both market share and sales volume. While the top line remained disappointing compared to the company's delivery numbers, there is a more positive metric hidden inside the data. NIO's vehicle margin checked in at 13.1% during Q4, compared to 11.9% during the prior year's Q4, and the same level as the previous quarter. This suggests that although NIO had to get more competitive on pricing, it was also able to reduce production costs enough to save its margins. So we know that NIO is expanding its sales and deliveries through existing and new brand launches, whilst simultaneously reducing production costs to save its margins. So why were both investors and analysts so disappointed by the Q4 earnings report? NIO's stock price had been on a steady rise through to March, right up until the company prepared to announce its Q4 results to the market. Although NIO sales are growing, they are simply not growing fast enough to offset the significant losses on the bottom line. The most shocking number posted in the Q4 earnings report was the overall losses to the NIO business, coming in at a whopping 974 million, an increase of 40% compared with the Q3 losses. And these sorts of numbers are simply not sustainable for any business to stay afloat. Something needs to change at NIO, and it needs to happen fast. On the recent earnings call, William Li made a bold statement. The NIO CEO remains optimistic that the automaker will achieve profitability in the fourth quarter of 2025. He stated that the company plans to take aggressive cost-cutting measures and operational restructuring to reach this profitability target. Now, I think this is unlikely based on the current sales numbers, but not impossible. What do you think? Leave a comment below if you think NIO can do it. And during the company's earnings call on March 21st, Li told investors that negative public sentiment had significantly impacted sales of its Onvo brand, with sales volumes coming in 30 to 40% lower than expected targets. The company also faces pressure from geopolitical trade tensions. For example, the European Union approved tariffs on Chinese EVs last year. This came as the EU found out that EV makers in China benefited from massive government subsidies, allowing them to undercut rival producers. Additionally, the US raised tariffs on Chinese EV to 100% last year under former President Joe Biden. And now President Trump has now announced a 100% tariff on Chinese-made EVs, locking NIO out of the US market. NIO is making progress and continues to grow its sales and top-line revenue. However, the company continues to struggle with operating losses and slower sales of its Onvo brand that could limit its growth this year. While the company is taking some necessary cost-cutting measures, it remains to be seen if these planned cuts will be enough to turn a profit in the fourth quarter of this year, as the CEO expects. Another reason for negative investor sentiment is the company's financial guidance for Q1 2025. NIO now only expects to deliver around 43,000 vehicles during Q1, which would provide a revenue of around 12.9 billion yuan. Now, this is well short of the 65,000 vehicle target previously stated by NIO management. And this reduced Q1 guidance has upset investors, causing many of them to sell out their stock and look for another opportunity. And for investors that are still hanging on to their NIO stock, they're asking a big question. Will NIO ever reach profitability, and when will this happen? According to CEO William Li, Q4 2025. But investors are not convinced. One of the biggest questions investors have is, how does NIO plan to reduce the massive losses posted in Q4? And NIO is aggressively cutting costs to maintain vehicle margins, but at the same time, it's still spending huge amounts of cash expanding its battery swap network, which is a key part of the NIO product offering. It does not appear spending on the swap stations and the expansions will not stop anytime soon. So cost savings will have to come from somewhere else. Where these big savings will come from is anyone's guess at the moment. On a positive note, NIO has recently partnered up with CATL, the world's largest battery supplier, with the goal of creating the world's largest battery swap network. NIO and CATL are establishing the world's largest and most advanced battery swapping service network for passenger vehicles by leveraging their strengths in technology, management, platforms, and brand influence. Additionally, they'll collaborate to drive the formulation and adoption of a national standards for battery swapping in China to enhance battery compatibility across different brands and models. Initially, NIO and CATL will focus on strengthening their sharing of battery swapping network and accelerate the development of battery swapping services. CATL will support NIO in expanding the battery swapping network, whilst its own ChocoSwap technical standards and network will be integrated into the newly developed models of Firefly, NIO's new brand. Both parties' networks will operate concurrently, providing EV users with a more seamless and efficient swapping experience, thereby making battery electric vehicles more convenient. Furthermore, CATL will invest up to 2.5 billion yuan, around $346 million into NIO Power, solidifying the partnership. CATL already holds an 11% stake in Wuhan Weining Battery Asset Co. Limited, a financing entity established in 2020 to manage NIO's battery leasing business, also known as Battery as a Service. So, what does all this mean for NIO investors going forward? NIO missed estimates and gave weak Q1 guidance, but its Q4 wasn't terrible. To counter Chinese EV price war, NIO needs to refresh vehicles, launch new ones, and find revenue without drastic price cuts. If NIO sales growth aligns with its vehicle delivery growth whilst cutting costs, 2025 could be a strong year. However, questions remain about its battery swap strategy, overseas expansion, and slow top-line growth. Management aims for profitability in Q4 2025, but to achieve this, may need to double the planned sales to offset the ongoing EV price war. If you've enjoyed my analysis of NIO, subscribe to the channel for more videos. And for more information on NIO in 2025, check out this video here. Thanks for watching.